All right, now we're broadcasting. Don't want to get too far into that. I've done that before.
I remember.
Yeah, no, I thought this case was super interesting this week. Like, I actually really enjoyed it. But yeah, it's very interesting. I'm kind of like with the toss-up with the whole which VC firm to go with still. Like, it's kind of a hard decision on that.
Yeah.
So let's jump right into the questions, I guess.
All right.
Anyone have a spiritual thought they wanted to share? Just jump to number 3.
Well, I was reading in the scriptures just in 2 Nephi chapter 9, how Satan's working to catching us and make us to be miserable like him. And one of the most important things that Jacob is teaching us on that specific chapter is just to remember that we have Jesus Christ on our side, and remember that we have the atonement, and to use it actually, because we all are not perfect, and certainly we're going to commit some mistakes, and we will make those every single day, but that's not our goal. But just to keep in mind that we can become like Jesus just by using his atonement, and just relating it with a case. I mean, it's because Jesus Christ, it's every single thing we do is important by him. And if our homework, if our cases and everything of that, it's important to us, also it's important to him, because his atonement was just not for our sins, but everything which is important for us to understand and to learn, and just to overcome those things. Just that.
Yeah, thanks for sharing that. It definitely, like, when you keep an eternal perspective on life, I feel like it makes like having a career seem like a lot more meaningful in a way, I guess. And that we like really need to be searching for like guidance as we do this, because I'm sure like we can receive a lot of guidance as we enter in like career fields and everything.
Yes.
I just wish I would have taken this class like a year ago, because I feel like this class has just like sparked my interest in just business overall. Like I want to learn so much more now. Now I'm wishing I would have paid better attention in my accounting classes, because I didn't.
Yes.
But
it's very interesting to learn all the accounting concepts and having related with this class. It's just making sense.
Yeah. And I remember a lot of it, but at the same time, like I took my accounting class like a year ago, so it's like, dang, I really wish I would have like learned that a little bit more thorough, so I could just understand all this a little bit better, which this class is like really helping with, just kind of getting some of that refreshed in my mind a little bit. But yeah. So jumping right into number 3, what does BzzAgent do? What need is being met? Well, they're just marketing. They're just marketing through word of mouth, and it's honestly like pretty awesome what they're doing. I think.
They are using a process which is called viral loop, which is going from mouth to mouth to make the referrals and to get known their products to their customers. So that's the best way to do marketing.
Yeah, I just said they're a person-to-person marketing business, and it said somewhere like, what was it, like one person-to-person interaction is like better than 600
65
people. Was
for 600? Yeah. Like 650, I think, or something like that. Yeah.
Crazy.
It's incredible. Yeah. And like these stats are from like 2005 to 2010, I guess, maybe. I mean, this was actually like currently in like 2005, so it makes me wonder like where that is currently right now.
Right.
If kind of those statistics still kind of hold true today. because obviously things change very fast. But the first bullet point under 3 was, what about the product market fit? Have they demonstrated demand they profitably serve? And absolutely. I mean, there's all these different companies out there that want to get their products marketed more or more out in the market, and they've just basically found a way to do that, and it's extremely profitable for both sides of the equation, for the client and for BzzAgent.
Yes, I agree with that.
So yeah, they definitely found a good product market fit.
Because actually they don't have any product. It's just where they are taking someone else's product and going outside and selling it.
Right.
Yeah. I think that'd be so cool to do. I want to do that. So the next bullet point was, what makes BzzAgent successful? I think mainly just the fact that they're able, like he just tapped into the fact that using word of mouth is way more successful than normal advertisements through television or internet or other forms, and he just found a way to get people to do it.
Yeah, I basically just said they found a more efficient way, kind of like what you're saying, just like a more efficient way compared to the typical advertising. It's obviously successful so far.
One other important thing is that they were having a certain amount of agents promoting a specific product. It's not all of their agents, but according to the product, they were qualifying their agents to sell that product. So that's something very critical to target the market according to the customer needs and the agent abilities.
Yeah. And the funny thing is, I actually went and Googled BzzAgent, and like they're still around, like a full-blown company, and you can still sign up as an agent if you qualify. And then like if you can qualify for a certain product, like you can just become an agent for them. And I'm like, why not? You know, I think it'd be cool. It'd just be a cool experience.
Yes, it could be.
So as a group, pull out the case and discuss Table A and Exhibit 5. Take your time as you work through the following questions. How profitable is BzzAgent? So Table A, which one is that?
I think it's on
like right.
That's on page 5.
Page 5, I'm getting there. All right, there it is. So it said, and Exhibit 5, I didn't really look at that one, but how profitable is BzzAgent?
Says they have a net profit of 55,000. Well, actually, that's probably millions. So 55 million with a net margin of 25%.
Which is really good.
Yeah.
That's a lot of money for them. Now going to the Exhibit 5. I'm just getting there.
Yeah, I'm there. I just got here.
So the Exhibit 5 is several pages as well.
Yeah.
Net income. So they're looking at their net income. I mean, in 2004, their net income was a loss of $265,000.
But making any comparison with 2004, we come up with $879 million. Yeah, sorry, it's 2005. So if you go to the net income of that year, it's $879,090 million. So that's a big improvement. So you're able to see they jump from a loss of 67, then to 18, then to 265, and then up until 879.
Yeah.
So that was almost 4 times the previous year. Well, actually 3 times.
definitely steady.
Yeah,
growth.
so they're growing extremely fast, like profitability wise. And it says like the very far right column, their forecast for 2006 for their operating margin to still be at 26.4%. I mean, that appears to be really, really good still.
Yeah.
And then an income of around $3 million. That's pretty significant.
Mm-hmm.
So I would say they're really profitable at this point.
Yeah, they're very, very reliable.
And I think one thing that kind of like rung true to me was that at some point in the case, the owner, what's his face, starts with the B, Balter.
Yeah.
Yeah. At some point when he was like talking, like when the case was talking about the VC firms, he was saying like they're a winner, like they're an excellent company that's making a lot of money and they're going to do extremely well. So going to these VC firms, coming up with their own proposal shouldn't be that crazy.
Mm-hmm.
Like they know they're doing extremely well. So calculate the growth rate from the beginning of 2002 to the end of 2004, and from the beginning of 2002 to the end of 2006. Getting back to Exhibit 5. So the growth rate formula from 2002 to 2004. Trying to remember.
I found an equation for it, but I don't know if it's right. Anyway, but it's like previous year divided by current year to 1 divided by the number of years minus 1.
Yeah, I think that's it.
What numbers would we put in for the situation? Would we put in revenue or?
I think you put in the net income.
Net income?
Yeah, because it's asking the calculate growth rate.
Because, well, I found a different formula, but I don't know if I'm wrong, because it says the growth rate, it's the present value minus the past value divided the past value.
Yeah, I found that
and
one.
It will give us it will give us a decimal amount multiplied by 100%, so we can get the percentage. But yeah, so I was kind of thinking, because I tried with a net income, but it was not giving me a reasonable amount.
Yeah.
So how do you, what formula are you guys thinking?
I think Kevin's is probably the one that's right. Because I found that one too, and then I found this one.
What's your formula again, Kevin?
It's the growth rate, it's equal to the present value minus the past value, which will be the value of 2004 minus the value of 2002 divided the value on 2002. And then it will give us a decimal amount multiplied by 100.
Yeah, okay. Yeah, I think, I'm familiar with that one. I think that's it, actually. So let's go ahead and use that.
Because the thing that I was trying to understand was what specific value we are going to use. If we're going to use the net income or which one?
I was a little thrown off because in the next question it says, how satisfied are you with operating margin? Oh, no, not that one. How satisfied are you with revenue growth? So I don't know if it use revenue or net profit.
I think we should use revenue then.
Revenue.
Yeah,
okay.
That makes sense to me.
Like it says the that's on the page above. It says total revenue on 2002. It's 59,042. But it says but it says at the beginning of 2002. But it is just giving us at the end of 2002. So is it making any difference? Certainly, I think yes.
I think you would just use the end of 2002 because that's like the total revenue for 2002. I think you would just use that.
Okay, so at the end of 2004, we have 2,598,000 and 7. It would be minus 59,42, and then divided by 59,42. I mean, it is giving us 43.00. So, but after that, we need to multiply by 100. So it's given us 4,300, and for me that doesn't make sense.
Yeah, see, because that's why I was trying to solve it. That's why I was stuck with the equations, because it would give you like a ridiculous number, like it 4,000%.
Because in the video I was watching to calculate the growth rate, they said we need to use the valuation for 2002, and well, actually, just getting related with the case, but it says it was the valuation that we need to use, but that is why I was kind of confused with which amount we have to use in this one. Because it's in here, it says all you need to calculate a basic growth rate are two numbers. One that represents a certain quantity starting value, and another that represent is ending value.
Yeah, because growth. Yeah, that's right. Growth rate is just minus the old divided by the old times by 100, and yeah, using revenue, that's like not even really like making sense. Like I'm coming up with a growth rate that's just like 2,000%, or is that what were you guys getting on the growth rate?
4,000, I think. That's right.
4,300.
So where I'm trying to find.
So would we use then? So
I was looking in the wrong spot. That's why.
On Exhibit 4, then, if we're using evaluation, Exhibit 4 on page 17 gives us pre-money valuation and post-money valuation. And then we'd probably use Q4 of 2004 and let's see, 2002. And then we'd use Q4 of 2002.
Because let me check in here on page 2. It was
nice.
Because and then at the bottom part of the page 2, it says the opportunity, and in here it's mentioning something about the growth rate. Well, no, I don't know. First amendment growth rate. Now it is giving us some percentages, but I don't think we have to use those. It's just giving us percentages for all expenses they have. And then it says, even assuming a growth rate for the industry of 2%, word of mouth marketing was poised to be a $3 million market by 2010. But it's just mentioning a growth rate of 2% back then. So I don't really know how they came out with that number.
Yeah, I really don't know on this one.
I mean, just by the numbers, we can determine that actually they are growing very fast. If we take a look on the revenue analysis and the gross profit and the net income after all the deductions and expenses, they have a very good increase and improvement. But just to know what the specific information is, the one we need to place in the formula. And that one I got stuck.
Yeah, I mean, at least. Yeah, I really don't know.
I'm thinking, because so if you use valuation, that's what you're saying, Kevin, right? That's how you solve it, is valuation. So could we use Q4 of 2004, so 15.4 minus Q1 of 2003, and so that would be at the beginning, which would, I guess that'd be the end of Q1, but that's the closest we have to 2002. So we'd subtract 15.4, or subtract 15.2 from 15.4 and then divide by, let's see, 1 sec. Let me see if I get the real number.
Okay.
Where are you looking at, Kevin? So this is page 17, Exhibit 4. It gives you the pre-money valuation, the post-money valuation. Yeah, see, I got
Exhibit 4. Sorry, you're cutting out a little bit.
Exhibit 4 on page 17. Am I still cutting out?
Yeah. Yes, it says the average pre-money valuation. It says 9.8 at the beginning of 2003, and then at the end of 2004, it's given us 8.5. Is it the one you're looking at? It's where it says early stage, 12-month ending.
Yeah, and I was doing the post money. So Q1 15.2, Q4 15.4.
Yeah. Okay.
And for that, I got 1.315, which seems kind of small.
Yeah, 1.3%.
Yeah, that's not right.
But this is just like an average valuation, right?
Yeah.
So if they're post money, I mean, by 2005, their post money valuation was closer to like 65,000, though, right? Is what they're guessing. Well, or 50,000. So I mean, if in 2003 they started at about 15.2, and let's just say in 2004 or 2005 they were closer to 50, then like if they had a post money valuation of 50 minus 15.2 divided by 15.2 times 100, they're at a 228% growth rate.
That sounds more reasonable.
If at the later, so I did the later stage one, and that one I got 19.2%. I don't really know. I mean, I don't know what numbers we choose from.
But just kind of using those, if we use the average post-money valuation at a later stage, it's given us in the fourth quarter of 2004, 73.2 minus the beginning of 2003, which is 61.4. It's 11.8 divided by 61.4. Then times 100, it's given us 19.2%.
Yeah, that's what I've got.
Sounds more reasonable.
Yeah. So I mean, whatever way we look at this, whether we're taking the later stage valuation or the early stage, or we're taking like an estimate of like 2005 with after they've received their Series B financing, like obviously they're growing pretty darn fast.
Yeah.
Yes. So with the next point, we may say that we are very satisfied with the revenue growth because their net income was actually going and doubling in almost three times at the end what they got at the beginning.
Yeah. So yeah, their growth rate is pretty darn fast. How satisfied are you with operating margin?
Their operating margin.
Operating margin.
that one is
I mean, are you guys? Can you guys hear me very well? It's cutting out pretty bad on my end.
I can hear you.
Am I cutting out?
I'm gonna
No.
turn off my camera because I can't hear you guys at all.
Okay. Okay, but the operating margin, they went from 114.69% to 11.74% from 2002 through 2004.
Yeah, and I think maybe the reason why their operating margin was so high that first year was maybe because they just hadn't put much into it at that point. I'm not sure.
And one other thing is because they do not have too many agents to sell with and work with, as well as they were starting. So they have not a very high market to sell into. And that is why they were having this high operating margin percent. So in the end, by 2004, they were having a more well-structured company. So that was making them to lower this operating margin percent until 11.
Yeah. So an operating margin, what's the formula for that?
I think in this case,
So profit over sales, right?
Confirm it.
I don't know. Yeah, I'm not really sure on that.
The operating profit margin, just let me check here. It's just giving a different one. I just was reading about it, but I just didn't find it.
Yeah, so the operating profit margin is just the operating income or the income divided by revenue. So for the first year, I'm not sure how they got 114% because they operated at a loss. So I think what they did is that loss, total revenue was 59,000. I don't think they can like have a negative percentage. So I don't think that first year is like even really valid. But that second year, 2.61% is just their 18,000 or 18 million of operating income divided by their total revenue of 721 million.
Well, the formula for operating margin, it's operating income divided by net sales.
Yeah. So I mean, it's obviously increasing. Their profit is increasing. Pretty like the rate of their, so the operating margin is just increasing, which is really good for them. So obviously we're really satisfied with that.
Yes.
Move on to number 4.
Okay.
Yeah.
So if BzzAgent is growing and profitable, why are they raising money now?
They're trying to grow outside of the U.S., so that's like one way will allow them to grow faster. Plus, they have a lot of like duplicate businesses that are now trying to take their idea and see what they can do with it. So I feel like at this point, it's who can grow the fastest and take over the market first.
Yeah. And they also mentioned that they wanted to start just a social media or like some kind of media platform alone, separate from word of mouth. So that's another reason why they want to receive more funds right now so that they can grow a media platform as well.
Yes.
Can they succeed without VC funds?
I would say yes, but if they want to grow more, they need a venture capitalist funds.
Yeah, I agree on that totally. In what role does timing play in this decision?
Well, if they get the money now, it'll allow them to go faster. If they wait later, then the competition might take them out.
Yeah.
Mhm.
Yeah, if they wait, the other companies could, because right now they might have like the biggest grip on this market. But if they keep waiting, then other people might be able to jump in on that idea, get some funding from VCs, and start beating them out, like you said.
Mhm.
And then the last question for number 4, how much money does BzzAgent need?
Kind of like what we said, depends on how fast they want to grow. They probably don't actually
Mhm.
have money at this point, but they seem to be they're cash flow positive and they're growing steadily. And like it says on page 22, the net increase in cash shows that they have a steady amount of money.
Yes, I agree with that. Because they have money, just it depends on the growth rate they would like to have. Because also their forecast is looking very good for their net income. So in the end, they will be able to grow, but if they want to grow at a faster rate, it depends.
Yep. Yeah. And also, if they have more money available, they're gonna be able to do more, like with that social media platform. Basically, what you guys already said, but just grow at a faster rate, being able to do more options. And I know if they choose option B, they can't. Like they said at some point, they wanted to give out like so much million in funds to like the current investors or something like that, the founders or something. I can't remember exactly what it said. But they wanted to give that away, and if they don't get that funding, then they can't actually do that.
Well, that's what I was a little confused about because weren't the original investors were the guys who were working on the company now, right?
I
Yeah.
think except for one, because I think there was two like their initial like Series A investment. I think they had two of them, and I think only one stayed as a chairman.
Because I know what they were trying to do. I know is they were trying to they wanted to make it look like they already had a Series A, but technically they only had like an angel investor, and then the rest of the guys were just throwing in their own money. So they almost wanted to look like they had gone through the Series A process because they wanted to go to the Series B round and say, and that way they would be able to get more money for a smaller, and they'd be giving away a smaller amount of equity.
Yeah, yeah. I think that's exactly right. So how much do they really need? I mean,
I mean, they're already making like $1 million or something like that. So they would only anything over probably 2 million. So 10 million would be plenty, which is what they're asking.
Yeah, yeah. So number 5, open your spreadsheet. Compare the 50 million valuation and on a 15 million investment. So the 50 million valuation on a 15 million investment. Just looking at that, like financially to me, like it seems like it could be more profitable for them.
Yes, it can be, but also there are some consequences because whenever they are able to provide more authority to the venture capitalists and do all of that and accepting the terms for the other venture capitalist, I mean it's profitable for them, but as well there are some consequences. For example, just looking at the chart, first of all, we're able to see the post-money valuation. It's increasing $15 million from 50 to 65. The option pool from the 8%, it's going up until 17%. Also, they are changing the board of directors. They're having 2 Series B representatives, 1 Series A representative, having Balter and Kavanaugh, and also an independent chosen by Series B, and an annual 7% cumulative dividends payable.
Yeah. So it is interesting.
I would say this is a very tough decision.
Yeah, I agree. I think either way, though, no matter what choice they make, it's still going to end up being good.
Yeah, I completely agree with that. They could go with either one of these firms, and both firms, like, obviously are very successful firms. One has been around for 20 years and is one of the leading firms over in like Silicon Valley area, and obviously there's a reason for that.
Yeah.
And the other one, they're just like a little bit newer, but still very successful so far.
Correct.
So compare the 50 million valuation. So another thing that caught my attention was, I mean, really, they're only, so on step 2, on like the third, on capitalization tables, on step 2, they did lose, like, their current shareholders went from a 72% to a 59.9%.
Yeah, that's what I do. That's why I actually said go with the original plan, with BzzAgent.
Yeah, and looking, and I was kind of thinking that too, but then in step 3, in like a second part, like up in the wording, it says the VC term sheet states that no such repurchases will occur. In this instance, current shareholders own 5,514,950. So I mean, that's, oh wait, I'm kind of thinking out loud here again. Because there's obviously more shares available now. If they were to take the VC term sheet.
Yes, they're able to get more shares, but they are paying 1 cent less per share.
What threw me off is why would the VC come in and offer a better value or a more beneficial like agreement for BzzAgent? Why wouldn't, like, it seems like it would favor BzzAgent more than it would favor themselves. And so that's why I'm like, what's the catch here? Like, no VC is going to go in and be like, all right, your plan is good, but I'm going to like make it even better for you and not for us.
I think in this case, what they're trying to do is, because their option pool, like, they basically, that's where most of it went, because the Series B investor on the BzzAgent term was like, their percentage of the shares was 20%. Under the VC term sheet, it's only 23.1%. So only a 3.1% difference, which, I mean, is pretty significant, but not really that significant when it comes down to it. Most of it comes down to the option pool, which comes to like other people investing and buying shares of their company, which maybe they just think by creating it like a more open company and having people buying shares, it's going to just grow a lot more rapidly. I'm not sure, maybe because they have more experience and they think that's just a better option for them, is to make it more public and have more people be able to buy shares.
Well, it's just very interesting because by gaining 3.1%, they're given $5 million more in the investment, and also providing $10 million in the valuation, just by gaining 3.1%.
Yeah. And then in step 4, I think step 4 is like the most interesting and gives like probably one of the biggest things. But I mean, looking at the values, the current shareholder values, you're looking at almost a 3 million difference in value, one versus the other. But the option pool is like a 7 million difference. And then a Series B investor, you're looking at a 5 million difference of their value. Yeah, it's all really interesting. I guess we can kind of move on to number 6. We've kind of talked about a lot of this already, I guess. So using your spreadsheet, discuss the math you used to calculate your answers on the tab entitled 2 VC return requirements. So on this one, this was the one, like, I actually did use the answer key on the back on this one, just to kind of get me started. And obviously it was like F8, or the investment amount times the growth rate, or 1.3, 1 plus the growth rate, to the 5th power to get the 5 years out of their growth rate. And then I kind of did that for the exact same thing for the next one. It's different in the answer key than the way I did it, but I took their post-money valuation of 65,000 times the growth rate to the 5th, and I got the same answer, but I used a different equation. So I got it.
Okay, yeah, so the next thing to calculate the value of BzzAgent at exit, what we need to do is to divide the value of investors share at exit, which is 55,693,950, by the Series B ownership, which is 23.1%. So that way we will come up with 241,340,450.
Yep.
I'm sorry, 450.
For the implied revenue at exit, I just did F13, which was the value of BzzAgent exit divided by F13, by 2.5.
Yeah. Perfect. And then the last one, the required revenue CAGR. I'm guessing that's just the required revenue growth rate. Was 67.7%.
Yes.
So then we figured that one out. Number 7, how do the growth expectations affect your view on which term sheet is more favorable to management? So your growth rate for the BzzAgent one is 59.1%, and for the other one it's 67.7%. So they're expecting to grow at a much faster rate.
At 8.6, 8.6% more faster than just keeping the normal visit term sheet they are proposing.
Yeah, and maybe that's why they're offering that fight. Well, obviously that's why, but they're offering 15 million versus 10 million. They can use that extra 5 million to increase that growth rate. At least they should be able to do that. So go to tab entitled 3 capitalization tables. Compare your responses. If there are differences or questions about the numbers, help each other to come to the right answers. Yeah, so I felt like the tab 3 capitalization tables was fairly easy. At least step 1 was just the post money valuation was just 50,000 plus 15,000 to get 65,000. And then the Series B ownership, you just take the 15 million, sorry, not thousand, 15 million divided by 65 million to get 23.1%.
Yes.
Sounds good.
And do we have to go through all those steps? I think we do.
Yes, and step 2, I got for the Visa term sheet, the current shareholders by 60%, and then the option pool 17%. So that way we came up with 23% serious investor in total of 100. So there is the difference of the current shareholders having 60 instead of 72%, 12% less, and the option pool having 9% more. There's the investor 3% more.
Yeah.
Step 4, Series B price per share. I just did G9 divided by G32, which would be G9 is Series B investment of 15 million divided by G32, which is Series B investor of $2.1 million. $7.06.
Sweet. I think that's good, right? Everyone's good on all those, right?
Yeah.
Yes.
Okay. So number 9, why is price per share of the VC term sheet very close to that of VC? I think that's supposed to say of the BzzAgent sheet, very close to that of the VC term sheet, but the value to current shareholders is different. So that's possible because like more money's being put into it, I guess.
Yeah.
Yes, because they have 5 million extra.
Right.
Yeah. So more shares are being put in. So yeah. So which number is more important to you as a founder?
I'd say ownership.
What, Kevin?
I would say ownership of your company.
Yeah.
I agree with it because in the end, that's the most important thing, because if you don't know the company, I mean, you could have a very good price per share valuation and all of that, but if you don't own the company, it is not worth it.
Yeah. And then which number is more important to you as a Series A investor? It would still, like, the Series A investors still the current shareholders, right?
Yeah, pretty much.
Yeah. So, like, that would be like the most important number. Like for a Series A investor, I mean, you're at 72% and now at like 60% or 59.9%. So, but even though your percentage in the company has dropped, your value has increased by almost 3 million to 36 million to 38.95 million. So kind of interesting there.
Yeah.
So number 10, go to the tab entitled Class Prep Worksheet and discuss your responses to each of the questions.
Well, number 1, I just said my opinion hasn't changed. I think they're both great, but I think BzzAgent is better because it's more conservative. They'll keep more ownership. They'll get the money that they need, and they will have more of a say with the board of directors. So that's why I recommend BzzAgent's term sheet.
Okay. My answer was it's worth it to lose 3.1% in the ownership of the company by gaining a better growth rate in the end, because they will be able to expand their company and make their company even bigger and create more profitable ways to make more money by just losing 3.1%, but their growth rate and also having a very established company will make the difference.
Gotcha. And I said I would recommend the VC term sheet because they do have a higher growth rate. Their money valuation is higher by doing that as well. So to me, that seemed like, I mean, as long as they're still holding the majority of the shares, I would think like it would still be okay. And so that's what I kind of recommended on that.
Yeah, because I was thinking that too, but my reasoning for doing the BzzAgent one is because they might have to go back and get more investors. So I feel like the more equity that they own now is better because it's probably going to get diluted when they go back and get more investors.
Mm-hmm.
Yeah. Yeah. And that crossed my mind too. And I thought about that and I was like, dang, what happens if they do that? And then I thought, okay, what happens if they sell out and by 2010 in like 5 years and their company has grown and their valuation is higher, they will make that, they will have that higher valuation. So I'm not like, it's like, that would be such a hard decision. Like I can't imagine. Like fortunately, obviously you have like professionals that have done this many times and had decisions like this before. So they had a lot of advice, I'm sure, but still very tough decision, I'm sure.
Yes.
So number 2, the VC term sheet describes a more investor-friendly board, which would be that 8% to 17%. How much valuation would you give up in the VC term sheet in exchange for getting the board structure initially proposed by BzzAgent?
It will be $10 million because of valuation they are proposing it's 40 and they are getting 50. So if we won't take it, we will be missing 10 million.
Yeah, this question I kind of didn't understand.
Yeah, so is it like asking for your opinion on how much you would give up for them?
Yeah, how much valuation would you give up in the VC term sheet? Is that talking about shareholders, like current shareholders?
I'm guessing as owners, so it's like how much would the owners be willing to give up for the money?
In exchange for getting the board structure initially proposed by BzzAgent.
The way I was taking the question, it was because if we go back to the section 1 of this spreadsheet, if we go to the introduction, it says in the case of SERP table B, it says the pre-money valuation, the BzzAgent term sheet, it's 40 million. And then we go to the Visa term sheet, it's 50 million. So we will be giving up $10 million. That was the way I was taking the question.
Yeah, how much valuation would you give up? Yeah, okay, I guess that makes sense. I think I'm seeing how you're reading that, Kevin. How much valuation would you give up in the VC term sheet in exchange for getting the board structure initially proposed? So yeah, they are losing. Well, if we're talking about pre-money valuation, I mean, pre-money valuation, yeah, 10 million is what they're giving up. Or yeah.
Mm-hmm.
But then post-money valuation was 15 million.
10 million. I was taking it this way because it is asking us in what offer we are going to take. So that's why I was taking the pre-money valuation.
Yeah. But if it's referring specifically to the current shareholders, like the owners, they'd be giving up only 2.95 million because the post-money valuation, if they did the BzzAgent term sheet, was 36 million, but under the VC term sheet it was 38,950,000. So they'd be giving up 2.95 million. for that,
Uh-huh.
for their structure. Which, in valuation terms, for a large company, I feel like 3 million really isn't that much of a difference, but I'm not really sure. So I guess I can move on to number 3.
Okay.
The BzzAgent term sheet described a planned distribution of approximately 3 million to management and current investors immediately prior to the transaction. What is your opinion of the merits of such a distribution from Balter's perspective and from the VC's perspective?
I said it's not a good idea for them to give 3 million back to the current investors, because if I'm not mistaken, the current investors are the ones who are basically running the company now. Like you said, I think there's like 1 or 2 that aren't. And then as a VC, I wouldn't be comfortable with doing that. Why would I be giving you money just so you can kind of pay yourselves back?
Yeah, I kind of agreed on that. I mean, I thought those investors would get their money back through dividends and everything else, like, which actually I guess there was only like 2 investors from the beginning anyways. But in the case of like a sellout, obviously they would get their money back, but I don't think there's a necessity to, well, obviously you do have to pay that money back that you loaned out in the beginning, but to take out more money just to pay off that money or to give them 3 million, I'm not sure I completely understood that perspective or why they would do that.
Yeah, I didn't really get that either.
Well, one of the key parts of the question I would mention was prior to the transaction. So we will be giving out money beforehand, before something is done, before something is well structured, and before we're actually making a decision and planning ahead of time to do so. So for me, it wouldn't be a good idea.
Yeah. So I think in both perspectives, in my mind, I don't think it's a very good idea.
Mm-mm.
So I guess moving on to our last question, number 11. Have you guys been able to open up raising capital at BzzAgent B?
So I think we have to like do the poll, the BzzAgent poll.
Yes, after you complete the BzzAgent poll, you're able to access it. Before, it's giving you an error.
Yeah. Is it like, which poll is it? Is it the post poll?
No, the pre-post poll.
Yeah, I did the pre.
Did it?
There's just a BzzAgent poll, and I think then there's a post poll. So there's the pre poll, and there's like
It says the BzzAgent pre-discussion poll is the one.
Yeah, I did the BzzAgent pre-discussion poll, and I still don't have access to it.
There are 3 polls. So there's a pre-discussion poll, there's a BzzAgent poll, which I think we're supposed to take right now together.
Oh, yeah.
Post-discussion poll.
Gotcha. I see that. So, BzzAgent poll right now then?
Yeah, I just opened that one.
I'm opening it up right now. Should Balter go along with Kavanaugh's plan to hold a VC action? Yes. At least I think.
I can read that one. What is it? So should Balter go along with what are you talking about? They're just saying go with the VC. Should they go with the VC term sheet?
Okay.
So what's that question talking about then? So it says, should Balter go along with Kavanaugh's plan to hold a VC action for BzzAgent financing? Are they just asking, should they stick with BzzAgent's original plan or go with the VC?
I think, I don't know. To me, it seems like it's just asking that if they should just receive further funding from a VC. I don't know if it's asking for a specific one, rather than if they should just receive further funding. At least that's what I think. And I submitted it, and it actually like marked it like as all correct, and I put yes, but it had like a little blue arrow next to no. I'm not sure if that meant I was supposed to click no, but it still gave me the full credit.
It's because it's based on our criteria at the pre and the BzzAgent poll. So in the end, this part B of the case, it's just given us a more specific information on how they were evaluating every venture capitalist. And based on those, they were able to select, let's check here, they were able to select 1, 2, 3, 4 different firms that they could think of based on the chart they were evaluating it. They were thinking of the effort, the chemistry, the domain expertise, the chat, the value added, and making a total of all those points. They were taken from firm A through firm D and given a brief explanation of each of the optional firms to go with.
I'm still not able to open it. I can't even get it to open. I mean, it's opening, but the link is like blank. And I'm not sure if it's just loading or something, but I can't get it to work.
1 sec. Let me see if I can like upload it to Hangouts.
Okay.
Okay, I got it to open now. I had to open it in like an incognito site or a web page, and that worked. So looking at it, oh dang, it's another like 5 pages.
That's 4.
4, yeah.
Kind of talking about the same stuff as the other one.
Wait. Isn't it just exactly the same other than firm D is added?
And it's given us a chart to make the valuation for each one of those, giving them points.
Because isn't that chart in the first one?
It is.
Yes, but in here it's just providing a brief explanation of each firm added the firm D as mentioned.
Kind of looking over it real quick.
Is it firm C that gave him that offer that we just discussed?
It's firm B.
B. Firm B is the one that's offering the different different valuation.
Just the chart, it's providing different values. I just made the comparison with the chart we were given in the first part of the case, and then on this one being given in the second one, and it has different values.
Oh yeah, it does. So firm. Well, I mean, looking at this a little bit, kind of glancing over it, the first bullet point of number 11 is, as a group, decide which offer you will take, if any. Like you were saying earlier, Kevin, like I feel like if they took any one of the offers, like it could be very beneficial towards the company. Whether they took the BzzAgent term sheet or the VC term sheet that offered more valuation, I think either one of those could be a good option for them. But I guess as a group, we need to decide on the best one.
I would say they must go with the venture capitalist term sheet, because if not mistaken, at the beginning, it is saying that they were kind of in a hurry trying to raise the money because one of the wives of, yes, the wife of one of them was pregnant, if not mistaken, and they were trying to get things ready.
Right.
I would support for them to raise money faster than just going with their normal growing rate. Will be just to take the term sheet offer, because they were given 10 more millions in the premium evaluation and 5 more millions in the investment. So it will help them to get the money they are looking for at this time.
Yeah, I agree. Actually, now because I've been thinking more about it. If they do decide, like you guys were saying, if they do decide to sell soon, then they'd be getting more money because the valuation would be higher.
Yeah. Yeah. So, I mean, it's kind of a tough choice, but as a group, are we leaning more towards the VC, the VC term sheet?
Yeah.
Okay.
They must take advantage now.
Okay. So create one Word document for your group to state your decision and explain your reasoning. This should be a brief document. And then one person will use this BzzAgent decision assignment to submit it as the group.
Okay. We can just probably discuss it.
I can hurry and type it up if you guys want.
Okay.
So I guess as a group, we're going with the VC one. And the reason behind that is the valuation will be higher. Their growth rate is already good, so they'd be able to pay off the money quickly, right? And if they do decide to sell out, then they'll get more money because the valuation is higher.
Right. They will be able to now.
So I'm just gonna like kind of put this in like a bullet point form. I just said as a group we have decided to go with the VC term sheet, and then underneath I'm just gonna put a couple bullet points. The growth rate will be higher for BzzAgent. We also said if they sell out, they will have a higher valuation.
Yes.
Do we have any other, like, what are some other reasons why we're thinking more of this? The VC term sheet.
They get more money.
Yeah.
Yes. By just giving up 3.1% ownership, they will be able to raise faster money because they're in a hurry to gather the money. So by just giving 3.1% in the end, they will be able to raise more by themselves. And as you were mentioning, if they are planning to sell, they better take advantage of their company now than just in the end trying to invest more when they will be close to selling and not taking that much advantage of it.
Yeah. Okay.
I think that's probably everything.
Mhm.
And you could probably put that as the summary whenever like we started talking about the Word document.
Mhm.
Probably doing the summary.
That was like 5 minutes ago.
Okay. Yeah. And then the last thing, I think one more bullet point you could add is that the VC the VC firm that offered their own VC term sheet has a great track record. They have 20 years of experience, and what they've been doing has been working for 20 years, obviously, and they're doing it right.
Yeah. That's
So
good.
Okay, I've got that typed up. I'll just submit it for all of us so we can get that done, and then summary can just be the last couple of minutes, I guess.
Mhm.
All right, this was crazy long today.
Yeah.
Uh-huh.
All right, cool. Sounds good, guys. Thanks a lot.
Yeah. Thank you.
Okay, see you
Okay,
then.
see you later.
Have a good one.
Bye.